So now you have a trade from this high to this low here, and from this low to this high here. Understanding fake bottoms and fake tops has actually allowed me to get over 500k in funding. I'm going to show you guys the method I use, copy and steal it, and use it for your own trading. When we have a swing low or a swing high that is cemented in the market, we need to understand this one key thing. Do we have bullish order flow or do we have bearish order flow once we're reaching that high or low? That means, do we have fair value gaps when we are reaching that swing low or swing high? So once we approach this swing low right here, we don't have any fair value gaps in which price can mitigate. So that means there's a very, very high chance that price is going to approach this high here because there is inefficient order flow. And now we apply the same thing. If you guys are looking at this price action as bullish, we need to understand from this swing low to this swing high, there is no fair value gap. So we know this low will be taken out. And since there is no bearish fair value gaps from this swing high to this swing low, we know this high is going to be taken out, and so is this high here. Now, this is a concept I teach my students. It's called IDR, inducement range, when there is no fair value gaps from a swing low to swing high. So we know that swing high or swing low will be taken out. And to confirm if this is going to be a sweep and then we target this high here, all we need to do is just confirm in the lower time frame. So this is the 1 hour chart. We can now confirm this in the lower time frame. So here on the lower time frame, all we're waiting for is our bullish FVG to give us another bullish FVG. Very, very simple, something like this. Your entry can be on that fair value gap mitigation. Stop loss can be below this swing low here. And now you guys can target a 2-3R and then let the trade run to our overall draw on liquidity. Just like that, you guys can get a 10R, obviously partial, obviously do your risk management, all that. And now we could do the same thing to target this low here. If price is bullish, you'll be using our lower time frame fair value gaps here to push price higher. Since it is not using our fair value gaps here to push price higher, and now we make an IDR, there's a very, very high chance this low here gets taken out. All we're going to be waiting for is just bearish order flow. Entry on our fair value gap, stop loss above this swing high, and now we could target this low down here for a 3R trade. So now you have a trade from this high to this low here, and from this low to this high here. Now, these do occur with time, which is very, very important, which I do talk about with my students. So if you guys are interested in learning about fair value gaps, time, and price, I do highly recommend joining the Discord, in which you guys can find the link in the bio.